The show now is Vikram Dhawan. He's head of commodities and fund manager at Nippon India Mutual Funds. Vikram, hi. Thank you so much for joining us. I want to start by asking you about the gold price decline. And last week was nearly $100 of a fall. How are you reading this price movement to begin with?
The price action that we have seen in the past few days rather, appears to be more technical than fundamental. What actually happened was that there was fund selling, concentrated fund selling. I mean, funds have been selling gold now for the past 2 years, including ETFs. But that coincided with the Chinese market being offline for the national holiday. And even the Indian festival season is some days away. And typically, central bank buying only begins once the dust is settled in. So it was more of you can say, a mini perfect storm for gold in the past few days. Now, looking ahead, it's worth appreciating that gold is emerging from an extremely hostile macro environment. Just to give you a few statistics, in the past 2 years, the Federal Reserve rates have gone up by over 500 basis points. The dollar index is up by about 14%. The outflows from gold ETF have been to the tune of 600 metric tons. And even silver ETF, the outflows have been to the tune of 6,000 tons. If you talk about the open interest in COMEX for both gold and silver, they are down by 30 to 25%. Despite that, we have seen decent positive returns in gold and silver in the past 1 year. So I think the narrative that a stronger dollar and stronger yields can result in a one-way market down. The jury is out there. It's not a foregone conclusion, because why this disconnect happened between the gold prices and silver prices and the macros was because of very steady physical demand and extremely outsized central bank buying. So looking ahead, if the central banks, again, just to share statistics, last year they bought close to about 1,300 tons, which is a 55-year high. And this year in H1, they have bought close to 400 tons, which is again a 20-year high. So if the central banks continue their, the gold buying that we have seen in the past 1.5 years, and if the physical demand remains steady, I mean, we have to appreciate that we are at the cusp of the festive season in India, and the correction in prices bode very well for the physical demand during the festive season, both for gold and silver. So, if we have central bank buying continuing at the same rate, and if we have steady physical demand, and if this gets combined with, cracks appearing in bond yields or dollar, again, it's very difficult to predict when that may happen, may or may not happen. But if that happens, then you will have the stars again getting aligned for both gold and silver.
All right. But what's your sense, if I can push you to that, Vikram, on the gold price view going forward from here?
There is a dichotomy in the market. There is a dollar price. There is a prices in other currencies. I mean, look at last week, the gold prices in yuan and yen, and I think probably ruble also, were close to their all-time highs. So I think there is a dichotomy in the market. There is $1 price, and it is not surprising that we are seeing a lot of selling in the funds emanating from North America, because probably US is the only major economy right now which is red hot. Well, maybe India is also doing good, but if you see at the rest of the world, most economies, most regions are facing challenges. So I think dollar price is one indicator. But again, we have to see what kind of price realization we have in each country, in each region. So I think the Indian investors should be more concerned about the INR prices going ahead, which I feel, as I mentioned, if we have these 3-4, events lining up in the next few months to few quarters, things will be a lot more conducive for gold and silver than we have seen in the past.
We have seen that actually, Vikram. In dollar terms, the gold has declined, but in rupee terms, we haven't seen that much of a decline coming in. Having said that, within the asset classes or even outside the asset class, how would you rate gold and gold holding in a portfolio?
Last financial year, gold was one of the best performing assets. And, investors who believe in multi-asset strategies would probably gain from such moves because it's very difficult to predict which asset class will perform how in a particular calendar year or a financial year. I think 2-3 things need to be kept in mind by the investors as far as gold is concerned. I mean, if you look at the long-term past historic data, during times of recessions, gold is the only gold has been the best performing commodity. Now, if you have having a multi-asset approach to wealth creation, and if you're looking to diversify away from debt and equity in your portfolio, then gold ticks a lot of boxes. Secondly, I think one other thing which the investors need to also take note of that, and this is a study which was done by World Gold Council. It's available on the website. That only when the risk assets like equity, the volatility or the corrections are to the tune of 1, 2, or 3 standard deviation, that is when the hedging attribute of gold kicks in. So I think these 2-3 things have to be kept in mind before considering allocation to gold or silver, as the case may be.
And then final question then, what would you advise an Indian buyer in sense of portfolio holding when it comes to gold?
So obviously gold has shown its its attribute as a value of store of value rather, on a long-term basis. It is also a hedge against currency depreciation and also a hedge against black swan events, recessions, and volatility in the risk assets. But I think there are a couple of things, couple of messages which I like to give, suggestions rather, not messages, that especially for the youth who are looking to create wealth through capital markets. I mean, the current generation, the Gen Z generation, is considered to be asset light generation, and they don't believe in buying houses and hard assets. But at the same time, they may want to diversify into some sort of hard assets for hedge against inflation or a black swan event. And gold is one of the solutions that they may want to keep in mind. Now, from the general investor's perspective, I think as the portfolios become bigger for every individual or an organization, you need to diversify your risk. And the good thing about a diversified approach is that you not only are able to participate in the long-term trajectory of each asset class, whether it is debt, equity, or gold, or commodities, etc., but because of the poor correlation amongst the various asset classes, the volatility of your portfolio remains quite low, significantly low. So I think this is the approach which the investors should have for wealth creation. I mean, mutual funds are not the platform for traders or tactical play, but I think that if you're looking towards a well-diversified portfolio, because I think we all talk about compounding, but if you really want, and compounding really works well if the volatility of your portfolio is low. And there's no point having a portfolio which is up by 20% one year and down by 20% next year. So if you have a portfolio which is diversified, then the compounding becomes more certain. So I think gold is one of the asset classes which can be used as a tool for this sort of investment philosophy and objectives.
Okay, all right, Manisha, thanks very much for that. And definitely a risk off is what we can see in the equity markets at this point in